It is now my pleasure to invite our dear friend John Angelo. You're going to say hello? So while I introduce John, he's going to be mingling. John Angelo is going to lead off our Real Asset panel. John is the co-founder and chief executive officer of Angelo Gordon & Co., a leading alternative investment management firm with approximately $22 billion of capital under management. Angelo Gordon is a pioneer in the management of distressed securities and convertible arbitrage funds. Prior to founding Angelo Gordon, John spent 18 years at Rothschild & Co., where he managed the firm's proprietary capital and served as vice chairman. Besides being a big fan of John as an individual, I think the greatest approbation that I could give him is that he has made our group quite a bit of money, and for that we are most grateful. And without any further ado, ladies and gentlemen, please welcome John Angelo.
I rushed over to say hello to David Durst, I'm a fan, and I just wanted to let him know that we stayed last night at the Ritz-Carlton, and I didn't leave a wake-up because I knew I would hear him from here to there, and of course, I did. He's a good man. And I'm also listening. One of the things about Angelo Gordon, Kathy Cabral asked me, or told me actually, what I was going to talk about this morning, and what you may or may not be interested in hearing, which is the firm's global view. How do we feel about equities? How do we feel about Europe, Asia, and the United States? We don't have a view. We're credit analysts. Credit analysts are always bearish. The only thing good that can happen to a bond is that you get your interest and you get your principal, and we're very thankful to get that. Everything else that can happen is bad. We as a firm take advantage of the opportunities, and you have to raise money very quickly to do so. Now, we're fortunate to have been in the business many years, and we can do that. In the fourth quarter of 2008, we were managed to raise $5 or $6 billion, in which we generated very handsome returns. We did so because the opportunity was vast, and we could explain it, and we could show it wasn't we bought something because it was cheap. It was a situation that had a beginning, a middle, and an analyzable conclusion, and we were going to make the money, and we did. And that's the kind of business that we're in. And it was not what I was going to say this morning, so now I'll go back to my prepared text. When I started in the not in the business world, but starting a hedge fund, which was in 1988, there were only three predecessors. It was George Soros, Julian Robertson, and Michael Steinhardt. And they ran global macro funds, highly leveraged. And their goal was to make, and it was a period of time when institutions did not give you money. It was all high net worth individuals. Their goal was to make as much money as they possibly could. But conversely, when it didn't go their way, they lost a lot of money. And I always felt that it was because of those fellows, and they're all friends, that the hedge fund world got a bad name. Because there are thousands of different hedge funds today. They all do different things. Some of them, such as ours, are pretty conservative. We don't warrant the media and what they say about us. So, 25 years later, firms such as mine manage close to $3 trillion. And consultants tell us that that will grow by 50% over the next 5 years. 2/3 of all alternative monies are managed by 5% of the alternative investment funds. 90% of all inflows to hedge funds are to funds with $5 billion or more. And obviously what that means is the big are going to get bigger, and in some cases much bigger. My firm is called Angelo Gordon. It was founded, as I said, in 1988 by Michael Gordon and myself. We had worked together 10 years prior running a prop desk. Today I like to think that we're a leader in alternative investments. We have an absolute return focus in terms of credit. 25 billion, I think you said 22, it's $25 billion under management, 300 employees, 100 professionals. Headquartered in New York City, offices globally. The three core investment disciplines: credit, which is how I grew up, real estate, which we're going to talk about later, I think, and private equity. I'm very proud of the fact that we celebrated our 25th anniversary this month, and our philosophy and culture holds some of the secrets to that longevity. Our investment philosophy really has never changed. When we were at Rothschild, we were told to manage money in spite of the market, which is the definition of a hedge fund, or to manage money in ways that didn't correlate to stock or bond markets. So the philosophy, as I would state, is match money with opportunities. Match money with opportunities on a timely basis. Size the opportunity. It makes no sense to raise $2 or $3 billion if the opportunity is $1 billion only. You'll only hurt your performance. Generate positive annual returns with particularly low volatility, and here comes the differentiator, without leverage, or if you're going to talk about real estate or private equity, with modest leverage. And modest means less than everybody else. Create diversified portfolios using fundamental research, which is another way of saying that we don't trade. Culture is another thing. It evolves over time. Most people would stand up and say, our clients come first. In our case, we say our clients are our only priority. And that's relatively easy to say if you're not a public company. And we can talk a little bit about that later. In terms of ethics and integrity, everybody would say today, after '08, that they have great ethics, great integrity. We have 12 or more disciplines and their combinations. We run 40 separate managed accounts. We have been audited hundreds of times. There never has been a material adverse finding. Differentiator. Departments work collaboratively. We all came from dysfunctional firms. It's so terribly important that every department, every portfolio manager is on the 26th floor of our building. And it's more of a walk-around culture. Everybody talks to everybody else. We've done some transformative real estate transactions. They came from the distress side. Real estate people don't like bankruptcy and tend to stay away. The Chelsea market in New York, if you happen to know it, we bought it out of bankruptcy and it became the meatpacking, it always was the meatpacking district in the city, but it's become the hottest area in the city. It was because of the Chelsea market. The Montgomery Ward Center in Chicago transformed it into retail, commercial, and condos. It was because of the distress side. Credit, it's not 7 or 8 analysts in loans or bankruptcies. It's everybody working together to help everybody else, and people are compensated that way, and that's a differentiator. Teams helping each other is a much different thing than a firm that calls itself a multi-strategy firm. When I began in the securities business, which was 45 years ago, all firms were partnerships. Limited capital, unlimited liability, and the sole purpose was to act as agents for their clients. And of course, none of that is true today. 2 seminal events bookended the last 30 years. Securities firms went public in the early 80s, taking risk with other people's money, and the removal of Glass-Steagall by the federal government basically allows banks to use their massive balance sheets to do lending on a global basis. Not all of this was bad. A great deal of good was achieved. However, unregulated, leveraged, misunderstood financial engineering culminated in the crash of '08. As to who caused the crisis, Tim Geithner said it best: look in the mirror. Everybody had a hand in it. Unchecked, unregulated capitalism always leads to booms or busts, and all the regulations in the world will not do away with the business cycle, and I just wish that our government and other governments understood that. What I learned from 2008 is that paper money, backed by promises, is only as good as the confidence of our citizens in the government. What happened to me in that period, we had about $3.5 billion of client cash. And as the market started to melt down, I wasn't sure what we should be doing with the money. First I thought, well, I'll spread it out among 10 banks. But then I thought, well, if one of the 10 goes under and I don't get my money, I'm just as guilty as if all of it went. So maybe I should split it 50% in Europe and 50% in the United States. Which bank in Europe? Which is exactly what I did. I took the strongest bank in Europe and JP Morgan in the United States. And then I thought, well, I can't keep it in cash, it has to be in treasuries. And then you go to JP Morgan and said, wait a minute, I want to put it in separate accounts with my own securities. I don't want this to be commingled with other accounts. And so it reminded me of what you always heard about the Depression. When we went from bank to bank to bank to a shoebox. And that would have been the only way I genuinely would have felt safe. The government's response to any crisis, policies and new regulations are the engines for growth of a new recovery. New ideas have to be quick, they have to be decisive, and they have to be strong. Some were, some weren't. But it's hard to criticize policy when politicians are acting in a nonpartisan way and facing unprecedented situations. A lot of good decisions were made under immense pressure in the fourth quarter of '08. But the real inflection point was in '09, when the Fed created a homogeneous way to accurately stress test all U.S. major banks. And with certainty of value, the portfolio within the banks began to raise equity, and with it the confidence in our system began to return, which is of course exactly what has to happen in Europe. The first 2 years after the crisis were particularly productive, the last 3 years wasteful, awful. I have been in the business for 45 years, but nothing has changed the investment management world like the crisis of '08. 5 out of the 5 top securities firms went out of business or became banks. Most financial institutions retreated to wealth management, something that they hadn't concentrated on for 15 years. Prop desks, proprietary trading desks at both banks and securities firms are scaled way back to a level of insignificance. Market making is no longer real, and what I mean by that is if I'm trading Tribune, I could go to JP Morgan today and ask them what their market is, 70.72. I've got $2 million to travel, that's $2 million. $2 million to travel. And today they would say, either let us work on it, I'll buy $1 million at 70 and let me work on the other. 6, 7 years ago, they would have given me that same market, 70.72. I'd say I've got 25 million to go, and they'd take it on the wire. That's a huge difference and a huge opportunity for a firm such as myself. Capital constraints, Dodd-Frank, Volcker rule, Basel II and III put massive pressure on banks to disgorge their core assets. The banks again become profitable, as they did in the last 2 years. It allows them to mark down their inventory and to start to make sales. And therein lies, again, enormous opportunity. Risk opportunity flows to the alternative investment world, as does the talent. Very, very different than 5, 6, 7 years ago. KKR, BlackRock, PIMCO, and firms such as ourselves take the place of yesterday's securities firms. Ask me a question later about going public. Banks no longer need their traditional partners to act as brokers when selling inventory. There makes no sense to go to Merrill Lynch, for a major bank to go to Merrill Lynch or Goldman Sachs, who's no longer making a market, and saying, will you take me out of 250 million XYZ? They come to us. Big difference. What it means for me is that I need financial liquidity, and it's imperative that I have it, and I'm prepared to use it on a daily basis. Today Angelo Gordon, has 100 counterparties that we never had prior to 2008. Lastly, regulatory change and reporting structures are so vast, so expensive, that a new hedge fund, $200, $300, $400, $500 million, can't possibly compete. So you have this numbers of alternative investment firms which really become the shadow banking industry of the world. It's an exciting place to be. What makes, and I alluded to this at the beginning, what makes our business so interesting are the dislocations. They're unexpected, They're always different from the ones of the past. Most investors, 95% of investors, spend their time trying to figure out how to hedge yesterday. Certainly our Fed, certainly our government, but what they should be doing is concentrating on how to take advantage of the future. So to you, I will say, to investors, use common sense, realistic expectations, patience, invest in things that you understand, and remember that complexity is the enemy. Let me talk for a few minutes about what the opportunities are as we see them. I indicated I grew up as a bond trader, became a credit analyst and a portfolio manager. I am particularly partial to the distressed or restructuring world. Most purchases have a beginning, a middle, and an analyzable conclusion. And as long as your research is good and you know what the conclusion is, the only enemy is time. Every bankruptcy in the United States, you underwrite at 18 months. That's normally what it takes. Tribune, which has been a good investment for us, took 5 years. We knew we were going to get 100 cents on the dollar. We have gotten 100 cents on the dollar. In fact, we've gotten more, but that's a function of the equity markets. But normally, it would have, instead of a 20% rate of return, it would have become a 5% rate of return. In the United States, if you were oversecured, if you were at the top of the capital structure, and you can demonstrate that in court, you will get 100 cents on the dollar. Most importantly, you participate in the outcome. If you are the largest creditor in your class, you control the outcome. And that is really important. There is an investment opportunity called Punch in the UK. It is 5,000 pubs, primarily drinks and smoking only. They literally own half of the locations and lease the other half of locations. They have $1.7 billion in debt. The problem for them was that the British government put an excise tax on alcohol and banned smoking. Two things that they had and did and what Brits like, and so they had terrible trouble. They split their company in half. To those, the bars that were owned and the bars that weren't, they split the debt in half so that there was 800 million pounds on one side, 800 million on the other side. We were able to buy $350 million of the leased pubs for 41 cents on the dollar from Barclays. So we got into that investment at about four EBITDA, as opposed to a public company would be selling at 7 or 8. We worked with and by the way, it wasn't just us. It was Sanctity and Avenue were the other two investors. We worked with management. We continue to work with management. I think that the company will be restructured in January. We'll end up getting fully paid and probably 23% of the equity. That's a great investment. That's a great investment. Those are the kinds of things that we all should be looking for. Ask any citizen on Main Street who's buying our debt and they'll tell you it's the Chinese. And of course, if you listen to David, it's not. It's the Fed. $80 billion a month, possibly the greatest Ponzi scheme ever perpetrated on the public. It will end, and it will end with higher interest rates and inflation. We don't know when, and we don't know how much. Keep in mind that inflation is the world's greatest robber. It indiscriminately extracts more wealth from the public than any tax, and by the way, is hugely regressive, unfairly brutal. But conversely, inflation is the world's greatest giver. It doles out benefits to people that borrow money, holders of hard assets, real estate, and of course the government. My guess, that is how we get out of the problems that we're in. But everybody in this room, including myself, we want to be part of the second group. That is the beneficiaries. We want to own hard assets, and in my case, particularly real estate, and I think that's the subject of our panel, and so I won't talk about that for the moment. I believe in the United States. I believe in our equity markets. However, I believe that we are range-bound, trading opportunities, but not the bull that everyone is talking about. 2012 and 2013, if we stay where we are in 2013, the markets are up 40%. It's not going to continue to happen. In a typical business cycle, as you begin to recover, sales go up, labor costs stay constant, profits expand, margins increase, multiples expand, and stocks take off. In the past 3 years, our so-called recovery, increased earnings are from cost-cutting and productivity. Revenues are not increasing, margins are not increasing. Economists forecast the S&P will earn $115, up from $110 this year. They are beginning already to cut their estimates. This is not what makes stock markets rise. For the bulls in the room, I'm mindful of the prospect of energy independence. I don't have to talk to Canadians about that. The turnaround in housing and the lack of other opportunities for people's money. But I still believe the repressive policies of our government will hold back any real bull market. Equities are very difficult to time. I believe in momentum. I believe in long, long swings. You wouldn't have thought that interest rates would have stayed as low as long as they have. I grew up in the market from 65 to 82. That's 17 years. The market went sideways. That's how I learned to do what I do, make money in spite of the market. But from 82 to 99, another 17 years, the market went up 10 times. And I want to own equities during that period of time. We just don't know whether it just started 2 years ago or whether it'll start in 2 or 3 years. The private equity model has a great advantage. We get 3 to 5 times leverage in a diversified portfolio. Management is incentivized as owners. Everyone's objective is totally aligned, and we control the exit. I want those funds, and I'm invested in private equity funds, to purchase good companies with great management and bright futures. So when the market has a multi-year rally, the private equity portfolio will be in a position to make multiples on my money. And that's, to me, what's important on the equity side. So I think I'm going to stop there and take part in the panel. And if
Thank you, John, for those wonderful insights. Just before we call up our 2 additional panelists, I just want to introduce, we have the pleasure of this panel being moderated by Mr. Frank Mayer. And just to give you a little background, Frank is the chairman of Vision Capital Corporation. Previously, Mr. Mayer was a top-ranked Canadian research analyst, and most recently, Frank was the vice chairman and senior real estate analyst at Desjardins Securities. His senior executive management experience has included roles as head of research, member of the Office of the President, chairman and vice chairman, and their fund Vision Capital has won numerous awards over the last number of years. There are too many to list. And ladies and gentlemen, it gives me great pleasure to welcome Frank Mayer to the stage to introduce our panelists this morning. And as Frank comes up, I would invite John Love and Harry Gloga to please join us on the stage. Thank you.
Good morning, everybody. And thank you for that kind introduction, Mo. Well, I guess John Angelo needs no introduction. I would ask John Love, can you introduce yourself?
My name is John Love. I'm founder and managing partner of Kingset Capital, which is Canada's largest private equity real estate investment firm. We have we've raised $4 billion of assets, or of equity over the last 10 years. We currently have about $7 billion of assets under management. We have 2 investment streams. One is an opportunity fund for large pension funds, and its life-to-date returns have been a 2.2 multiple and about a 27% net IRR. And then we have $1 billion of equity in a core income fund, which is aimed at ultra-high net worth individuals, and it's had a life-to-date return that's been about 14% after fees and expenses.
Harry? Mr. Harry Goldgut.
Thank you, and good morning. Thank you for inviting me to this wonderful conference. I'm Harry Goldgut. I'm a senior managing partner at Brookfield Asset Management. I also chair our renewable power and utilities group. Brookfield is a global asset manager. We're one of the largest asset managers of real assets in the world. We manage over $175 billion of assets. We have more than 100 years of experience as a firm owning and operating assets. The roots of the company are Canadian. Our head office is a block from here at Brookfield Place. Our focus is on property, infrastructure, and renewable power. Of the $175 billion of assets under management, over $100 billion is in real estate, about $20 billion in renewable power, about $25 billion in infrastructure. We're focused on real assets because of their long life and their stable and growing cash flows. We operate these assets with world-class operating platforms and dedicated professionals. Our clients have unparalleled access to investing with us through either flagship public entities or private funds. We have a growing base of 200 investors. We have a global footprint, and that gives us access to global capital and global opportunities.
I thought to put this panel's discussion in context, I'd quote from Harry's boss, Bruce Flatt, who in his recent letter to shareholders said the following: "With instability everywhere in the world, Abenomics impacting the Japanese story, tapering and debt ceilings affecting the United States, banking and overall debt levels influencing the Eurozone, growth worries affecting China, and the Syrian situation muddling the Middle East, global institutions are placing greater amounts of capital in real assets as there is nowhere else to hide. All of these trends continue to fuel greater allocations to real assets. More importantly," I guess he's talking about Brookfield, "we believe real assets provide a high quality and attractive real return that will continue to be ideal for institutional investors for many years to come." So, having said that, this question is directed at each of you. Where do you see the greatest opportunity for investing in real estate assets today? John, why don't you lead off on that one?
Well, let me start by saying that the Canadian market is different globally. It is sort of unique in the global context in the relative lack of volatility, and that's because Canada has the benefit of three things. Number one is a small and controlled banking sector. I've often said the 5 bank chairmen get together every Tuesday and dictate policy of lending to real estate. And so that disciplined capital flow makes a significant difference. Secondly, the ownership in the Canadian real estate industry is consolidated around highly professional management, with a limited number of groups controlling a significant component of the activity, with a lot of governance and a lot of discipline. And thirdly, cost of capital has been very sophisticatedly doled out. And so you've got proper assets being traded or developed with disciplined capital. And the sum of those three factors has meant that in the 08-09 global financial crisis, there was fundamentally no impact in Canadian real estate. And in fact, there's been a significant long-term de-risking of commercial real estate. Now, I should say specifically to the question, I think that the Canadian market, while it is particularly attractive for low volatility, you won't find distress. It's difficult to create big bangs or big wins. It's not a hit it for the fence structure. But for investing long-term, solid growth, low volatility, it's a very strong market. And there's an old saying that everybody can measure return, but few people can measure risk. And measuring risk is the key aspect of real estate investment. And the Canadian market has some very solid elements that contribute to allow you to do that risk evaluation and make make great investments. So I think commercial real estate in Canada, for those investors looking for low volatility and long-term growth, particularly in a inflation and interest rate volatile environment, is a solid investment.
Harry, where do you see the greatest opportunity for investing in real assets today?
There's lots of opportunities that we see in the infrastructure space, and I'll go outside of the real estate world and just talk about that area. If you look at the need for new infrastructure, the build-out that's required is quite incredible, and then there's the rehabilitation of existing infrastructure. And I'm talking about electricity transmission lines, I'm talking about roads, bridges, those kinds of assets. The build-out required due to GDP growth in certain geographies, so thinking about Latin America, for example, countries like Brazil, Chile. Rehabilitation required in places like Canada, the United States. And then if you look at just some of the other factors contributing to this. So we've talked about Europe a little bit and the deleveraging that's required, not only in that country amongst its corporate owners, but governments, not just there, but generally. So the need to raise capital to invest in these kinds of assets goes beyond the abilities of governments today in most places, which again leads to either privatizations or triple P type of arrangements, but more private sector involvement in those assets. The other element of just risk transfer, getting governments out of the business of providing infrastructure and into the hands of private sector investors who may be better able to handle that risk and get it off the backs of taxpayers to relieve the financial pressure that's on some of the governments as we know today. And so whether it's in transportation, whether it's in power generation, we see a number of opportunities and a very strong pipeline of these things really on a global basis.
John, I see you nodding your head in agreement. Do you agree?
I agree. I agree with infrastructure, but I'm not going to talk about it. But I do. We lease our space from Brookfield, and you've been great owners of our property, just to let you know. Although I don't know why it takes so long to get from downstairs to upstairs. That's another thing. Real estate, we do a great deal of real estate, both in the United States, Europe, and Asia. I'll mention the latter two. We're raising a fund in Europe simply to take advantage of the $2.3 trillion of real estate that is going to come out of the banks. Mostly value-add real estate where we can fix things up and sell it as core. Mostly Great Britain, Germany, and the Netherlands, the places that we've accessed, we can generate pretty good returns. The area that I'm in love with is Asia. I'm in love because of the demographics, because we've been treated very well. We've been there since '04, really since the beginning of real estate purchases. In mainland China, we've done 26 transactions in total, and it's a very different type of purchase there than it would be anywhere else. The government tells you what you're going to buy. We use operating partners that can help us to build 400 units in the city of Wuxi. And what happens, which is, to me, what makes it so exciting, is that there are 400 units being built. We pre-sell 300. The citizens themselves put up 50% of the cash. We build 50% of the building. The government looks, they say it's fine. They give us the next 25%, and then the following till completion. Our profit is the last 100 units that were never sold. We've done it 26 times. We've generated very high returns. We paid a steep tax to the Chinese and still generated 20% rates of return for our U.S. investors. So I like that business.
So everywhere but North America, is that it?
I didn't mention North America. How can I not say the United States? We run two types of real estate funds. A Core Plus fund where, let's call it trophy type transactions, which have gone, well, we run a Core Plus fund and an opportunistic fund. The opportunistic fund today is to generate 17, 18% net to the investors. Prior to this, 20%. Core Plus to generate 12% rates of return. We've done 3 Core Plus funds since '07, and every one of them has generated 500 basis points more than the opportunistic funds. And the reason is because people are so cautious, they're so careful, they believe they can get 12%, they don't believe they can get 20%. So the core and the core plus have been through the roof. Opportunistic, it's still a value-added thing. We've got to reposition, refinance, restructure everything and bring it to a core. It's a much harder business.
John, in the context of your remarks about low volatility, we know that real estate is amenable to high amounts of financial leverage. Do you think there's too much leverage in the Canadian real estate industry today? And if so, what are the implications for high net worth investors in different real estate sectors?
Well, I think the use of leverage in commercial real estate has changed, dramatically over the past, say, 40 years. I mean, there was a time in the 60s and 70s, in the what I'll call relative infancy of the business, where it was dominated by entrepreneurs who, by definition, had no money, and so leverage was 90%, 100%. It was, sometimes, more. The changes that in the aftermath of, the recession in the early 90s was the recapitalization of the industry. So today you've got a relatively low level of leverage. I mean, REITs are all below 50%. Institutional investors are typically, 10 or 20%. Our core fund is more sort of mid-40s. So those are all manageable numbers. But it's interesting because leverage is only a tool. And if somebody's going to lend you money, 10 years, 3.5%, I can figure out how to invest in real estate and make more than that. But as interest rates rise, which they will, as they go to 5, 5.5, 6, mortgage rates, which we'll see, then the game becomes different. And I think you'll see leverage rates will fall further because they will not be risk accretive like they are today. So I think not only are our leverage ratios manageable today, and certainly in this environment, stress test proof, I think they'll fall as interest rates rise because they won't be risk accretive.
John Love talked about rising interest rates, and a lot of people's knee-jerk reaction is when interest rates rise, the game is over for real estate. Can you still make money if interest rates rise, as John alluded to and as David Rosenberg suggested?
You can certainly make money in real estate. I think we'll lose it in every other asset class. Yes, because the disparity, just as he said, borrowing money at what you said, 3.5 for 10 years, and at the same time, core assets, core plus assets.
I should say, 3.5. We did 10-year financing at 3.1 in May. Now, May was a cycle ago, but those numbers became foolish, in my view. It's inconceivable that interest rates can't rise.
And you can buy assets at what kind of cap? I don't know in Canada.
5.5 to 6.
Long-term leases,
high
quality tenants.
Yeah. Best of class, there are a few things drifting into the 5, but if you're buying at a 5 and financing at a 3, you've got 200 basis points of positive leverage, and that can be an okay business. Now, it still comes back to all real estate's not the same, as you would know, and quality rules.
I would suggest that is a great business because you're locking money away, hopefully, not even hopefully, making 200, 300 basis points, and when inflation comes, you're going to make a fortune. That's the key. And all of us have to think about that. What happens when inflation comes? Do we have enough real estate? And it really isn't just your house. How much of your assets really, which I think is a liability, my house, but how much of our assets in real estate? Are they in REITs? Are they properties that we own? Can we own ground leases? This is what I try to spend my time doing for my children. And I can talk about that and stories about that, but I think it's the right place to be.
Harry, you made a persuasive case earlier for investing in infrastructure, in real assets outside the real estate category. Given that there are so many sophisticated buyers investing in the space, how do you avoid overpaying and putting capital at risk, particularly with the geopolitical risks of investing in various countries around the world?
The first rule is discipline, and I'll come back to that in a moment. But I guess it depends on a number of factors. How do you source your transactions? So to the extent that, from a Brookfield perspective, we can avoid an auction, that's usually a good thing, because auctions just generally determine who paid the most. And so we spend a lot of time doing a lot of what I call missionary work, building relationships with owners of these assets, looking for proprietary opportunities, looking for a financial restructuring, perhaps, complicated transactions, and then the elements that you bring as a purchaser, so as a sophisticated buyer to some of these assets, not having to buy with a financing condition, the ability to do bigger transactions, ultimately trying to either reduce or eliminate competition. But fundamentally, it comes down to your view on returns. Again, a hallmark of Brookfield's investment approach is that in the funds that we operate, we are the largest investor generally in all of those funds. So our interests are aligned with our fellow investors, and it's our capital that we're investing, and we think like owners and behave like owners, and if it looks too good to be true, it usually is, and we're not afraid to say no. And during those heady days of leading into the financial crisis, when valuations were really jumping off the page, you'll find in our track record that those were the years that we invested the least amount of capital, because we just wouldn't do it.
One last question before we throw it open to the audience for their questions. You've all been in the industry for quite a long time. What is the biggest difference in investing in real estate and real assets today compared to 20 years ago? John, do you want to lead off on that one?
I think there's three significant differences, which I did sort of lead off with. But one is the much more sophisticated allocation and cost of capital, allocation of capital and the cost of capital. And we've seen the securitization of a significant amount of non-institutional quality real estate in the REITs, and the institutional quality real estate in the pension funds. Secondly, professional disciplined management. Gone are the entrepreneurs who could do no wrong, and they're replaced with highly skilled professionals, but very few of whom would be known to this audience. And if you think back 20 years ago, and you said the name Campo or Reichman or Trump or whatever, those were all the real estate names, right? Whereas today, people would probably not know anyone, including me. And the last thing is, there's significant structural impediments is the wrong word, constraints or limiters in the Canadian marketplace, which we don't have a lot of global competition, and global competition inevitably leads to excesses, and because it comes in a wave and goes out in a wave. We've got a banking sector that is disciplined and constructive, and does its job well, but is disciplined and doesn't get out of line. And so, cost of capital, professional management, discipline.
John Angelo, what is the biggest difference in investing in real estate today compared to 20 years ago? And what does it mean for our investors?
I think, and I agree with John, that there has been a very low percentage of assets 20 years ago that were in the real estate markets in terms of pension funds, and that continues to creep up, and I think that's a very important aspect. The other thing that's particularly interesting, I do spend a lot of time going around the world, effectively, and talking to sovereigns, whether it's Korea or Singapore, et cetera. And I have a good friend at an unnamed pension fund in Korea who said that he wanted to buy, he would buy anything that was in a mile radius of the Bank of England. And of course, he wasn't sophisticated, but he understood that if it was in that area, that it was probably an okay thing to purchase. And I get that. But what is different, I suspect this is true in Toronto and Canada as well. The great fortunes that have been made in New York City have been made in real estate and kept, and those families continue to pass it along. And people, we're such short-term investors. And people should really, that person, when he's talking about the mile around, the radius around the Bank of England, he wants to own it for 25 years. The sovereigns want to own these things forever. This is the only way they can put their money to work. And so I think it's a much bigger market than it used to be 20 years ago, much bigger.
And Harry, do you want to apply that to real assets generally?
Yeah, the biggest changes I've observed is just the number of the way infrastructure has evolved into an asset class that's become very attractive to invest in. The number of buyers, the number of investment vehicles that have been created to invest in infrastructure. There's clearly a huge appetite on the part of investors. We've just finished raising a $7 billion infrastructure fund with over 60 institutional investors participating in it. It took 11 months, so there's clearly lots of appetite to invest.
I think John has a point he wants to make.
I'm on the board of Sotheby's, and I want to make a point, not now, I'll do it afterwards, about the art market. Because all of us as high net worth individuals own some types of art. It is extraordinary what has happened in that market. It is extraordinary. I'll give you an idea. There's a lot of auctions at Sotheby's, for example, are $5 billion a year. But at 25% of it never come to the market. They're sold privately. And if you have a $60 million Dorimar Picasso, great Picasso, they can get 5 bidders from 5 different countries in an hour to create a bidding auction. It's amazing that market and what can be done.
That's a subject for another panel, I think.
It is?
Paintings.
Oh, no. So I'll be around if anybody wants to ask me about it.
Okay.
If you have a Dorimar.
Now's the time to ask your questions.
Question is directed to John Love, but anyone can answer. You suggested and mentioned that interest rates are rising to 5-6%. And fortunately, I've been to a lot of chief economists who have said the same thing, but the time frame that everybody has said is a year or 2 years. They've been saying this since 2010. What is a realistic time frame of interest rates rising?
First of all, when I was using the 5 or 6%, I was talking about mortgage rates, and so they're 1.75% above Canada's, let's say. But we saw, and just to use 10-year Canada's, because nobody ever talks about those, they just talk about treasuries, but they don't matter to me, so I'll talk Canada's. We saw 10-year Canada's get as low as around 150, 160 in the spring. They should be 350 to 4. That's what I think is a normalized market, which brings mortgage rates to 5 to 6. Okay, so just to use that parameters. I have been wrong 3 years in a row saying that interest rates were going to rise. Because I just look at it at 150, what are the odds of it going to 1? At some point it's ridiculous. And the fact is the economy, I think, is doing a little bit better. I mean, if we didn't have TV to see the spectacle in Washington, and just ask people how their businesses were doing and how their lives are doing, it's actually, I think, a little bit better than we think. So I'm of the view that the economy is recovering, that will cause an increase in economic activity, and the bond market will respond to that. Now, I've been wrong 3 years in a row, so it shouldn't be any different this year. But I think that I felt strongly that what we saw in June was a harbinger of more rates to come, and I would have said that 10-year Canada's would be through 3% by now, and they're sort of 2.75. And I think the wind came out of the sail with the shenanigans in Washington in late October, and that put a pause button on things. I think that pause button is going to come off. I think we'll see I agree with David Rosenberg that the 20-year or 30-year bond market, bull market in bonds, is clearly over. And I think we're in an inflection point. Whether it's 6 months from now or 18 months from now really doesn't matter. But for sure, unless there's some economic shock that we can't foresee today, that I think that you'll see 10-year Canada's at 3.5% within 18 months.
This is a question for the panel, including Frank. Shouldn't we be careful about investing in real estate-related investments at 5% returns, REITs, 5 caps, when the financing is going to go to 6%? I mean, I'm sure long-term we'll make money on it, but over the next 5 to 10 years, which is a typical private investor time horizon, aren't we going to get caught in something bad?
John?
It's a great question, and it's so on the money, that narrow issue. So what I think you have to do in today's market is you sell income and you buy growth, because what's valuable is growth. And let me just give a specific example. Super regional shopping centers rents are set by the sales performance of the retailers. The sales performance is when they're selling their pants or whatever they're selling, and that's directly tied to inflation. As I think you'll see, as interest rates will rise, not in isolation, they'll rise because of increased economic activity and some inflation that comes out of that, and that will cause retail sales to rise, and you'll get a direct benefit in super regional shopping centers. That's just one example. There's other examples where there's real estate where you're buying at a lower cap rate because the rents are below market or whatever your assessment is. I think buying fully stabilized buildings with no growth opportunity at a 5 cap is a bad investment. Just for the reason you identified, which is the 3% or 3.5% interest rates we have today is just a term subsidy. It's not a lasting value proposition. And so part of the issue is you just can't buy any income stream on that basis. You have to buy an income stream where you think there's growth, because well, at least we feel for a fact that when you refinance that debt 10 years from now, it's going to be substantially higher, and you better have the growth that more than offsets it.
John, are you itching to answer that question?
I would just reiterate the point that one of the things that we look for in the investments in the infrastructure space are embedded growth opportunities, whether it's through capital improvement, capital expansions, increased revenues, reducing costs. But I agree, if all you're doing is buying a coupon-like return, you could be in for some sad times.
Let me give you a specific answer on my part. It strikes me that cap rates for, let's say, apartments in Toronto are roughly comparable to cap rates in Calgary. The difference is that in Toronto you have rent controls which are related to inflation, and I think the current increase allowed is less than 1%. In Alberta, you have no rent controls, you have a free market, you have a huge influx of population, manifesting itself in a vacancy rate in both Calgary and Edmonton close to 0. Rent increases in Calgary are running at 7.5%. I was talking to a private landlord who told me on his portfolio rent increases are as much as $175 a month. So logically speaking, where would you buy apartments? In Toronto or in Calgary? You buy in the growth market. I'm following up on what John said. Let me ask a question of John Angelo. I was intrigued by his comments because I was listening intently to them. You indicated that the best time to buy is when there is a dislocation. What can you envisage? What will be the next dislocation that investors in this room and yourself can take advantage of?
It will be when, and we're talking about it, when interest rates rise. They're not going to rise slowly. You saw it in the summer. I mean, interest rates in the United States rose 100 basis points in 30 days. The markets panicked. No one knew what to do, and it's going to happen again, and it's going to be worse. I don't know what Janet Yellen, I've never met Janet Yellen. One of the things that's interesting as an adult, that when you meet a president of the United States or when you meet the head of the Fed, they're just not that impressive. It's quite extraordinary. And when I first really was introduced to the Fed, this gives you an idea, there were this is '07, there were 246 PhDs in a building and not a single person in the securities business, not one. And out of that, I can tell you a story if you have time your hair will curl. You have 2 seconds?
Go ahead.
Bear Stearns is going down. There is a window. That's the purpose of the Fed. You give them treasuries or you give them creditable securities, and they give you cash to allow you to continue to run. 7, 8 times a week would be typical for someone using that window. Bear Stearns, on Thursday night before they went down, put in 3,400 different securities. And they had 17 Bloombergs at the Fed, and what they would do is get the CUSIP numbers and go through the Bloombergs. The Bloombergs crashed. Why did they crash? Because they didn't have the second series. They hadn't paid enough money so that they could get the next, and I can understand that, that's fine. So they quickly, it's 7 o'clock at night, and they start to call the Bloomberg to get to the next service. There's no one there. No one that can answer it, no one that can do it. They get Mike Bloomberg out of bed. This is the mayor of the city of New York. They explain the problem. He calls Bloomberg, they call back. It's going to cost $350,000 to get to the next service. And some very bright person said, done. Now Bloomberg that person went to Geithner and said, the problem is solved. And Geithner said, well, how did you solve it? And he said, I said that we would pay $350,000. If they didn't, the market wouldn't have opened the next day. Geithner said, you can't do that. We need an RFP. There you go. That's what's running the financial markets of the United States.
Ladies and gentlemen, thank you. Panelists, thank you.